The stock market is going to crash sooner or later. It could be this year because of the AI bubble. It could be 3 years from now because of some other problem. But if you're investing in stocks, you will experience a crash. So the question is, are you ready? In this video, I will use my 18 years of professional investing experience, both on Wall Street and here in Europe, to help you prepare for the next crash. To explain the first step, let me ask you an important question. Do you have a plan for what you will do if you get hit by lightning? Well, probably not, right? I mean, it's a 1 in a million chance. But here's a different question. Do you have a plan for what if you get rained on? I mean, if you live in Northern Europe, you will get rained on many times per year, so you probably have a plan. Check the weather in the morning, and if it looks rainy, bring an umbrella. And with this little bit of preparation, you turn a risk that could ruin your day into a minor inconvenience. Well, too many beginning investors treat the risk of market crashes like it's the risk of getting hit by lightning, but actually it's more like the risk of getting rained on. It's not a question of if it will happen, it's only a question of when and how hard. I pulled together some data on the global stock market over the past 50 years. Over this period, global stocks have been unstoppable. They earned 9% per year on average. They created trillions of dollars of wealth. But the road has been bumpy. If you look at the market month by month, around 3/4 of the time, the stock market ended the month below its all-time high. In other words, 3/4 of the time, your portfolio was down from the peak. And the median drawdown, the median fall from the peak, was 8%. That means that in a typical down month, you were 8% below the all-time high. But actually, a quarter of the time, you were down 17% or more, and 10% of the time, you were down 29% or more. If you invested 10,000 euros at the market peak, you would only have 7,000 euros left. Especially if you're a beginning investor, I want you to really think hard about that. This means that in a 10-year period, you would expect to spend 1 entire year spent with this kind of massive loss in your portfolio. If you want to succeed with stock investing, your step 1 needs to be plan for market crashes, because they are a normal part of stock investing, and if you do it long enough, you will experience them. In a few minutes, I'll explain exactly what to do when the market falls. But first, let me ask you this. What is more important for preventing plane crashes? Good maintenance and pilot training on the ground, or reacting well when the emergency starts? Well, of course, both are important, but to avoid a disaster, preparation is 80% of success. So the next few steps are preparations you need to make ahead of a stock market crash. Starting with this, build your safety cushion. This is money that you will have sitting in the bank for emergencies. You will not invest this money. A safety cushion is absolutely essential if you want to survive a market crash. For example, I had a good friend of mine when I worked on Wall Street who didn't have a safety cushion. And then in 2009, in the middle of the financial crisis, he lost his job. He needed money to support his family, so he was forced to sell half his stock portfolio at the worst possible time, at a huge loss. But if he had had a safety cushion, he could have stayed invested and recovered his losses. Now, some people take safety cushions to an extreme. They might have enough cash sitting around to cover 2 or 3 years of expenses. At that point, it's more of a psychological tool that allows you to invest 100% of the rest of your money in stocks without really worrying about it. But most people here in Europe don't need that much. So my step 2 is build a safety cushion to cover at least a few months' living expenses. Next up is step number 3. And I've got to warn you, this is a bit unpleasant. To make this work, you need to imagine ahead of time what it will be like to lose your money in a crash. I would ask you to sit down and look at your brokerage account. Let's say that you've got 50,000 euros invested today. Well, close your eyes and imagine that a crash starts, and you look at your account and you only see 30,000 euros. You lost 40% of your money. Then imagine that you open a news site and it says something crazy like there's a new war happening, or the biggest banks in the world have collapsed. Imagine that your wife or husband comes to you and asks, "What happened to our money?" Just imagine how that's going to feel ahead of time and see what your reaction is. If your feeling is, "Oh my God, this is a disaster. I can't believe this could happen to me," then that is an indication you should not be investing 100% of your money in stocks. Because this scenario, while it's not common, It has happened in the past and it will happen again in the future. So step 3 is to understand your risk tolerance and to take an appropriate level of risk in your portfolio. But what is an appropriate level of risk? Well, based on historical data, if you put 100% of your money into the stock market, you could expect to lose 40 to 50% in a really, really big crash. If you put 75% of your money in stocks, maybe you could lose 30 to 40% in a big crash. If you put 50% in stocks, the loss could be 20 to 30% in a really, really bad scenario. Now, I don't want to exaggerate this. When I say lose your money, I mean lose temporarily. If you invest in a diversified portfolio using index funds or ETFs, you will almost certainly get the money back eventually. But that will only happen if you stay calm and avoid expensive mistakes in the middle of the crash. And of course, this is not just about risk tolerance. You also have to think about your age. For example, if you're 20 years old, you've got all your life ahead of you. If the market drops, it's not a big deal. You can just wait for it to recover. But if you're 65 and about to retire and suddenly half your money is missing, that is a huge problem. That is why retired investors rarely invest more than 50 to 60% of their portfolio in stocks. So step 4 is adjust your risk level for your age and time horizon. Next up is step number 5. And if you're not doing this, it is really risky. But before I explain it, here's a real quick note. With the AI revolution happening and everything else that is in the news, the next few years will be critically important for investors. If you're not a finance professional, it can be hard to keep up with the market. When you see scary headlines, it's difficult to know, should I react to this or should I just stay calm and keep investing? That's why I send out an investment newsletter for Europeans every week. I cover investing insights and important news that all investors should know. If that sounds interesting, follow the link in the description to sign up. Okay, to understand step number 5, we have to travel mentally to December 1989 in Japan. Over the previous 20 years, the Japanese stock market had risen 15% per year on average, not even including dividends. At that point in time, Japan was the biggest stock market in the world. Magazines and newspapers were full of articles about the unstoppable innovation and creativity and hard work of the Japanese. Many people thought it was dumb to do anything except invest in Japan. But if you did put 100% of your money into the Japanese stock market in December 1989, then for several decades, you would have sat with big losses in your portfolio. Even if you held on to your investments for 36 years until today, you would have earned only around 1% per year on average. Over the same period, global stocks earned an average of 8% per year, and the S&P 500 earned 11% per year. This is the most prominent example of a popular beginner investor mistake: chasing returns. If you put your money into whatever investment has performed the best recently, it's easy to get burned. For example, over the past 20 years, the American stock market has been unstoppable. It has earned around 11% per year, compared to only 8.6% per year for global stocks. And today, the US stock market is the biggest in the world. It makes up around 61% of global stock markets by size. Now, looking at this, a lot of people say, well, American companies are exceptional. American capitalism is the best. The smartest thing to do is ignore the rest of the world and just buy the S&P 500. Now, of course, I cannot say that that is a losing strategy. It might turn out to be profitable. But this video is not about picking the most profitable strategy. It's about controlling your risks and preparing for market crashes. And from that perspective, just buying the S&P 500 is quite dangerous. As Nobel Prize winner Harry Markowitz said, the only free lunch in investing is diversification. If you want major market disruptions and crashes and bear markets to affect you less, you want your money exposed to many different markets, many different countries and currencies and industries. That means step 5 is don't choose investments based on recent performance, but diversify your portfolio globally. And then we come to step number 6, which is a little non-standard. It's not what most investment experts advise, but it's something that I personally believe in. So here's the deal. In investing, we can never avoid risk completely. If you want to make money, you need to accept risk. But we can kind of pick and choose which risks we accept. So if there is some particular risk that is really stressing you out, that is keeping you up at night, well, you can structure your portfolio to remove or reduce this risk. For example, if you're somebody who worries a lot about the AI bubble, if you are concerned that US tech stocks are too expensive, well, you don't have to force yourself to buy US tech stocks. You can build a portfolio that excludes US tech stocks by investing in small cap or international stocks. You simply have to accept that you will give up the upside if those US tech stocks do really well. This is not about trying to outsmart the market. You're not optimizing for maximum profit. You're optimizing for minimal regret. So if there's something that is stressing you out, step 6 is to optimize your portfolio to reduce those risks. So that covers preparation. Now we have the crucial question. What do you do when the market actually falls? Well, we have to start by addressing what not to do. That is actually the most important part. Investing is what's famously called a loser's game. To get a good result, you don't have to be brilliant, you simply have to avoid mistakes. And one of the most expensive mistakes that you can make is to sell when the market crashes. Don't underestimate how difficult it is to resist this. When the market is down 50%, when you see crazy headlines, you will be tempted to sell. You will be tempted to pull your money out to protect yourself and your family. And if a crisis continues for years, it can get 10 times as hard to stay the course. You will hear experts saying things like, "This time is really different. Maybe the market will never recover." You will be full of doubts and fears. What if I lose even more? But you've got to avoid the temptation, because when you sell in a crash, you lock in your losses and you'll never get that money back. Write down today, "No, I will not sell in a market crash. This is why I have a safety cushion. This is why I have a good portfolio with an appropriate level of risk, an appropriate mixture of stocks and bonds. I am prepared for market crashes and I will not panic." Write this kind of plan down ahead of time and you dramatically improve your chances of being able to resist. So step 7 is don't sell in a crash. Aside, of course, from your planned regular withdrawals if you are already retired. Next up, we've got step number 8, which is rebalance your portfolio. If your long-term strategy says you should be 70% in stocks and 30% in bonds, you need to check your portfolio periodically to make sure that it matches. When a crash happens, chances are that your stocks will fall in value more than your bonds. So you might discover that suddenly you have 60% in stocks and 40% in bonds. That is an opportunity to sell some bonds and buy some stocks until you get back to 70-30. Usually this works out quite well because when you rebalance, you are buying more stocks at a cheaper price. Okay, but what else should you do when the market crashes? Well, let's look at 2 scenarios. The first scenario is if you are not retired yet. So you're in the savings phase. You're still putting aside money. If that's the case, then usually the smartest answer is to keep buying even as stocks go down. Remember what Warren Buffett said, "Be fearful when others are greedy and greedy when others are fearful." Now, this doesn't mean that the market will recover quickly. It can keep going down for a long time, so you shouldn't invest money that you can't afford to risk. Certainly don't invest your safety cushion. But step 9 is to keep buying even when the market goes down. And then there's the other scenario. What if you are already retired and taking money out from your portfolio every month? How should you react to a stock market crash? Well, this really depends on how much money you're taking out and how much the market falls. If you are pulling out just 3 or 4% of your portfolio per year, and if the market drops just 10 or 20%, then you're almost certainly fine. There's no need to change anything. But if you're taking out much more than 4% per year, or if there's a major crash in the market, then it could be smart to reduce your withdrawal amount. Even a 10 or 20% reduction to how much you take out could dramatically lower the risk that you will run out of money in your lifetime. To be really effective with this, you can write down a specific plan, like if the market drops by more than 20%, I will cancel our summer rental by the sea, or I will sell one of our 2 cars. So step 10 is this. In a big crash, reduce your spending, reduce your portfolio withdrawals. And then I've got a bonus step. This is for the market timers in my audience. You know who you are. Maybe you've heard many times that market timing doesn't work, that you should just start investing and keep investing no matter what happens. But even so, you feel nervous about the market and you think there's going to be a crash. So you're not investing. You're standing on the sidelines and waiting for stocks to become cheaper. Well, on average, that really is a losing strategy. But if you want to do that, learn how to invest before the crash gets here. For example, look at the COVID crash back in 2020. The market was down for just a couple of weeks. If you start learning how to buy stocks or ETFs in the middle of the crash, chances are you'll be too late. Not to mention, it's going to be really hard psychologically to invest your first 1,000 euros to press the buy button for the first time when the market is really down and all the news headlines are scary. So, step 11 is this: learn to invest before the market crashes. Put some money into the market, get used to buying stocks or ETFs so that you are ready when the opportunity comes. Although, again, over the long term, the smart approach is not to wait for the crash, it's to simply start investing and to keep investing even as the market goes up and down. Now, if you live in Europe and want to learn investing, this can feel overwhelming in the beginning because you've got 100 questions like which broker or investment app should you trust with your money, and what strategy makes sense for your age, your goals, and your tax situation, and when is the right moment to start? Should you invest all your savings at once or spread them out over time? And how do you handle taxes? Because of all this, many new investors either never start at all or they jump in and make expensive mistakes. For years, I've been teaching beginning investors in Europe how to get started with ETFs or index funds. If you'd like to find out more, just follow the link in the description.